In this presentation, we will work a problem related to future value of one, and future value of an annuity within Excel. Our information will be up top. We're going to enter that information into the data, into the blue areas down below. This is how we do recommend setting up the information with the text in one cell and the data in separate cells, so you can refer to that data using references, that being the most efficient way to move forward. Here is our data set. We're going to use the rate 14%. We're going to have our series of payments here. Now we're looking at future value as opposed to present value. Typically, when we consider future value, the common scenario is an investment type of scenario. And that's going to be different than capital budgeting typically, but we want to give some examples of the future value as well so we can compare and contrast future value and present value. The other thing that's a little bit confusing about future value is the rate and the term future value. Remember that when we compare and contrast present value and future value, we often think of the future value as being an amount that's going to have to be more than the present value. In other words, if we had the same amount and we're trying to get the same amount of value either today or sometime in the future, someone's going to have to give somebody more money in the future to equal the same type of value as today. We may think of that in terms of purchasing power, meaning the value of the dollar goes down, and therefore you're going to need more money that if it's going to be given in the future in order to equal the same purchasing power today. That's inflation. The other thing we might be considering with terms of investments, however, is usually what's going to be our rate of return, and then think about how much money we will have in future dollars. So in other words, if we're going to have a series of payments that we're going to put into, say, a savings account or something like that, then what will our future money be? Obviously, when we consider it, we're thinking about just actual dollars as of a point in time in the future, and it is what it is at that point in time. We're going to be measuring it as whatever the dollar amount is in the future dollar amount. So just consider that when we think about an interest rate like this, we're often thinking about an interest rate that's going to be our rate of return, our return interest rate on the investment, and that's going to give us what our future dollar amount will be. And we're going to use this future value. It's going to be a typical kind of scenario for that. So if we had a cash flow such as this, we're going to say that in year zero, we'll imagine this is an investment. We have $30,000. That's how much we have so far. We're going to think we're going to invest $5,000 at the end of year one, at the end of year two, at the end of year three, then go up to $8,000 at the end of year four, and $10,000 in the end of year five. So if that's the case, then how much money will we have at the end of that time period? If we were just to add up the cash flows, it would be $63,000. But of course, we're hoping to gain investment on the $30,000 over that time period, the $5,000 over the 4 years, the $5,000 over the next 3 years, and so on and so forth. So we should have more than that in terms of future dollars, in terms of our growth of the investment. Now, there's a couple different ways we can format this data. If we see something like this, you could say, well, it's not all even payments, so we can't just have an annuity. We could break it out by each year, the cash flow, and see what the future value is per year, which is probably the best way to do it. And we'll take a look at an example of that. Or we could try to break out some portion of the annuity. In other words, 5,000 we can think about as going all the way through, 5,000 each year as an annuity. And then in years 4 and 5, we can think about the amount invested over and above the 5,000. And that would be kind of the least amount of numbers that we can crunch this down into in terms of formulas, or a lesser amount of numbers than breaking out each year. So that's what we'll start off with. So if we go down to our calculation, we can say, all right, let's start off with year zero. Year zero, we're going to take this 30,000. It's going to grow over the entire 5-year time period. So that's going to grow over the 5 years. So we're going to say, let's use our formula to do that. We're going to say this is negative future value to flip the sign. That's why it's a negative, why I put a negative. Double click the FV, the rate 14%, comma, and then we're going to take the number of periods, which is going to be 5. And this is the confusing thing. It's starting at 0. There's going to be 5 periods, at which point we're going to say this is what the future value is at the end of 5 periods. So we're going to say 5 periods, comma, and then we're going to take the payment 0 because this is not an annuity. This is going to be a 1, future value of 1, and then we'll take the present value number, which is that 30,000, and enter. So that's for year 0. Then we'll take the annuity from 1 all the way through 5, saying there's 5,000 included in all these years. So years 1 through 5, we're going to say 5,000, and then we'll account for the added 2,000 here, the added 5,000 here. So the annuity, we're going to say negative future value. Double click the annuity, and we're going to pick up the rate, comma, and then we'll pick up the number of periods, which we're going to say is 5, comma, and now it is going to be a payment because we're going to say this is a payment of 5,000 that's going to go through all the way to year 5. So it's an annuity. So we'll say there it is, 33.51. Then we need to account for the 2,000 above the 5,000, 8,000 minus 2,000 in year 4. So I'm going to pick up the year 4 added 2,000 amount. So we're going to say negative future value, double click the future value, pick up the rate, comma, number of periods, which in this case, now this is a little bit confusing because now we're here in year 4. If we go one more, we've got one more year out. So I'm going to pick up 1. It's going to be 1 year until we're done here. And then we'll say, comma, it's not a payment because it's not an annuity, comma, and then we'll take the present value, which I'm going to say brackets, is going to be 8,000 minus 5,000 or 2,000, right? Because we already accounted for 5,000 in the annuity calculation. So we'll say, all right, and then it's going to want to add a bracket at the end. So we added a bracket at the end. For year 5, we're going to account for the other 5,000 that's over and above the 5,000 that we accounted for in the annuity. And it's going to be at the end of year 5, so it is what it is. It's just 5,000. So this is just going to be that 5,000, which equals the 10,000 minus the 5,000 that we put in, that we don't need to future value it because it's being put in at the end of the time period. So if we then to sum that up, if we were to sum this up, we're going to get our total future value. And that's what we would think that we would have at the end, given this stream of payments at the 14%, 99,233 in future dollars. Okay, and of course, at that time period, that's what the dollars would be, in so many dollars. That is what it is as of that time period. But they're in future dollars because, again, of course, those are the future dollars, and their value at the future dollars, if we were to compare it to what the value of the purchasing power would be today, it would be something different. So that's what the growth is in terms of just dollars in total. Okay, so what if we broke that out in a year-by-year basis? So we could do the same thing. We'd say, okay, what if we said 1, 2, 3, 4, let's start with 0, 1, 2, 3, 4, 5, and then total. Now, what can make this a little bit easier for us to do is to basically reverse these years in Excel, and that'll make our calculation a lot easier. So we'll say, let's do this. Just equals 5, equals 4, equals 3, equals 2, equals 1, or we can obviously just reverse the calculation. What that'll do is it'll allow us to do the autofill function much faster. Then we'll put in our series of payments. This equals 30,000. I'm just going to hit enter and then autofill down. So there's our 30,000. We'll then autofill down. There's our series of payments. And now we'll just future value each year. So here's the actual year. Here's the number of years that we're going to use in our future value calculation. So we're in year 0, which means we have 5 years out in our future value calculation. So here we go. We're going to say negative future value, double click. The rate is up top, 14%, comma. The number of periods is going to be 5, not the 0, but the 5. That's why we did this, comma. 0 for the payment, comma, and we're going to say it's 30,000 is the amount. We'll do the same thing all the way down. So we got negative future value, double click the future value, the rate 14%, comma, the number of periods now 4, because we're in year 1, 4 years out to get to the 5 years, comma, and then we're going to say 0, comma, and the present value 5,000, enter. Negative future value, double click, pick up the rate 14%, comma, number of periods is going to be 3 now, comma, payment 0, comma, and present value 5,000, enter. negative future value, double click the future value, rate is up top, comma, number of periods is now 2. So we're in year 3, 2 periods to year 5, and then comma, 0, comma, and 5,000. Negative future value, double click, rate 14%, comma, number of periods now 1, comma, payment 0, comma, future value or present value is the 8,000. Okay, there we have it. And then the last one is what it is because we're at the end. We don't need to present value it because it would be at 0, which would be it is what it is. And now we could sum this up. And there's going to be our same 99,233. So this is just another way we could do this. Now we could do this a little bit faster by using absolute references. So if we delete all these, we can actually go all the way down and put a formula into this last one because it'll pick up 0, which means it'll just be the 10,000. So we could say, all right, let's do that. And I'm going to say this one is the future value. I cannot copy that down because if we do, it will do that. And it's pulling down the rate. So we once again needs to absolute value the rate. So I'm going to double click on it, go back up. That's in B1. So in B1, we're going to say F4 or put a $sign before the B, $sign before the 1 and enter. Then we can autofill that down. And there we have it. So and it even puts a formula here. It still comes out to 10,000, of course, because we're at years 0. So those are a couple ways that we could see that type of payment. We can also use a goal seek type of function here. If you were to think about our investments, we're saying, all right, we think we're going to get a 14 rate of return, and we think we're going to get around 5,000 in these years, but I'd like to get up to 130,000 in terms of our total investment. And we might be able to think, well, how much does this need to be for these 3 years? Notice that these are all equaling this number. So if I change that 5,000, I want to change that until I get this number up to 130,000. So for example, if I change this to 6,000, we can say, all right, now we're at 103. What about 7,000? Oh, 7,000, and it's changing these 3 numbers, and that changes all of our calculations. It's the same calculation we did up top. So let's let goal seek do that. We're going to say, all right, goal seek this. We're going to put our cursor here. We're going to go to the data tab. We're going to go to the forecast section. We're going to go to the what if analysis goal seek. And we're going to tell Excel, hey, we'd like you to set this to be 130,000 by changing that cell. So let's think about that again. We're going to say, all right, Excel, this cell, please, would you make that in this cell, D44B, 133,000. We want you to just make that be 133,000 by adjusting a cell that's related in this calculation, which is the interest cell. So I'm going to say, okay. And there we have it. So now it adjusted this one. So let's do that one more time so we could see this cell up top. So we'll say if I make that 0, so here we have this, we're going to say, all right, goal seek. We want you to make this number be 130,000 by changing this number. Just keep testing this number until you get to a point where that number down below is 130,000. Okay, it does it. It says, I'll test everything. There it is, 11,883. Okay, 11,883. If we put that into our function, we get 130,000. So in other words, this is what we would have to invest if we wanted to change these 3 years under the conditions we've laid out at 14% to get our total investment up to that 130.